Okay, so this afternoon we're going to talk about some tax planning strategies that you can do both personally, your individual tax return, as well as your corporate tax return. There's still about 3 weeks left in the year. I know everybody's getting ready to, planning for the holidays, and we're in the middle of Hanukkah season right now. But, tax planning isn't always at the top of everybody's list, whether it's, planning purposes or to talk about at the holiday parties. But it is something that's important, and there are a number of things that you can do between now and the end of the year to reduce the amount of taxes that you have to pay the federal, state, and local governments. You can see, I'm not even going to bother reading this slide. You can see this is a bunch of legal disclaimers. I can boil it down to you. Basically, it says, you can't rely on anything I say today. You do need, because each person's tax situation and or company tax situation is different. This is general advice, and you need to consult with your own tax professional regarding your specific situation, because a lot of these things are facts and circumstances. And myself, Keeping Score, or the PHCC Educational Foundation, none of us are accountable or warranty any type of, give you any kind of warranty on this information, which basically means you can ignore everything I'm going to tell you, which doesn't make a lot of sense, but that's the legal world we're living in. This afternoon, I've got it broken up into two parts, basically. We're going to talk about some individual tax planning, things you can do, and then we'll talk about things that you can do for your company. And then, as Wayne said, we'll take questions at the end. If you have a question, and I see it in the box as I'm going along, if I can catch it then, I'll be glad to talk, take it then. Otherwise, we'll catch anything that might fall through. We'll get that at the end. If it's a more complicated question and it's something I need to follow up with you on after the program, I'm more than happy to do that. So let's get started. So let's look at the individual things that are going on the individual side. There's a lot of talk going on right now, but there's not any real big changes on the individual side. There's some of the Health Insurance Act provisions that are taking effect that will be impacting your tax returns. You'll be getting a new form in the mail beside your W-2 that's going to detail the health insurance benefits you received this year from the company. The rates, tax rates have not changed. Other tax reduction, a lot of the stuff really hasn't changed yet, because there's been no action by Congress this year that's passed into law. There have been bills introduced, and there's one in Congress right now that I'll talk about a little bit later regarding some of the things that you're used to seeing in the past. And then, depreciation hasn't really changed. The Section 179 deduction, as you've come to know it, where you can buy a lot of equipment and write it off 100% right then and there. We're in for a big shock with that one this year, and I'll talk about that when we get to it. So as I said, there really are no changes in the tax brackets this year. What you see on the screen for 2015 is the exact same rates and amounts that you saw in 2014. Dividends and capital gains rates, those also remain unchanged. If you are in the top tax bracket, which is 39.6% for ordinary income, your capital gains and dividend rate would be 23.8%. Otherwise, the maximum was 20%. If you're in the 0 to 15% tax bracket, so you're in the lower tax brackets, your capital gain or dividends tax rate is 0. If you're the quote middle income, so you're in middle tax brackets, your rate would be 15%. And then the 20% capital gain rate for taxpayers in the highest tax bracket, and actually that could become 23.8 if your taxable income exceeds a threshold that we'll talk about a little bit later. So basically from the tax bracket standpoint, if you're in the top two here, the 10% or 15%, your rate is going to be 0. If you're in the 25 to 35% brackets, your rate will be 15%. And then if you're in the 39.6, that will be 20%, and it may get that extra 3.8%. So capital gain rate could be as high as 23.8%, which is still a lot lower than the ordinary tax rate. One of the things that came into play a year or two ago that now is starting to kind of hit home, and it's hitting home with a lot of smaller companies, is this tax on the net investment income. And this was part of the tax package that came about with Obamacare and a way to pay for it, the Affordable Care Act. There's got to be a way to pay for it, and this is one of the ways of doing it through a net investment income tax, and that is a 3.8% surtax. Okay, so surtax means it's an additional tax on top of what your ordinary income tax rates and amounts that you would pay on. It's imposed on your net investment income. The big question is, what does net investment income mean? So I have it here on the screen, the definition of net investment income. It means net investment income is interest, dividends, royalties or rents, capital gains, passive income from a trade or business, or the very few people are in this area, but income from the business of trading in commodities or financial instruments. But the key part in there that I want you to see is passive income from a trade or business. A lot of us are set up in the HVAC and plumbing industry, a lot of us are set up as S corporations. S corporations by their nature, or partnerships by their nature, are passive income investments. But this is not going to hit us directly, because pretty much everybody on this call, anybody that might be in a partnership where their plumbing, heating, cooling company is a partnership or an S corp, is an active participant. So because you are essentially active in your business, that means you spend more than 500 hours a year in the S corporation or in the partnership. That makes your passive income investment active. So you will not be, so if you are an owner of it, or partial owner in an S corp or partnership that's in the PHC industry, this all businesses as well, but specifically for us, you're active in it, it's not going to be subject to the surtax, and that was a concern early on. The items that are excluded from this tax: wages, obviously, that's not investment income. If you are unemployed for any length of time, so if you get unemployment benefits, Social Security payments, interest on tax-exempt bonds, you sell the principal residence, your home, you've got that gain on the exclusion, self-employment income, and retirement plan distributions are not subject to this net investment income tax. Now, another way that a lot of us might have an investment where we can get caught up in this is if you have a rental property and you sell that rental property for a gain. The gain that you get, let's just say, I don't know, let's say you make $40,000 on the sale of a rental property. That $40,000 that you earn on the sale of that rental property is going to be subject to that 3.8% surtax. So $40,000 gain, you're looking at about $1,600 in additional tax on net investment income. But for those of us that are the middle class or the lower tax bracket, so to speak, this doesn't kick in until a certain threshold is met, and that's the amount that we have on this slide here. So this 3.8% tax does not kick in until your AGI is 250,000 or above if you're married filing joint, 125,000 if you're married filing separate, and everybody else, meaning if you file single or if you file head of household, that threshold before that tax kicks in is $200,000. Now, important note on this tax, as the law is written right now, these threshold amounts are not indexed for inflation. So while inflation is not a real high percentage at this moment, it's still not, it won't be adjusted every year as the law is written currently. So if you're close to that threshold amount now, next year you might end up in it. So it's something to watch when it comes to your investment income. Another aspect that came about through Affordable Care Act a couple years ago, another way to pay for it is what they call an additional Medicare tax. And this is an additional 0.9%, which doesn't seem like a large amount. But if you have a larger salary, a larger income, it can quickly turn into a large number. This tax also has a threshold amount, which happens to be exactly the same as the net investment income tax. So married filing joint threshold, AGI over 250,000, married filing separate, 125,000, single filed taxpayers, head of households, 200,000. The same threshold applies. But the tax is on your Medicare wages and any self-employment income that you have. And that, once you get over that threshold, so let's just say you're a single individual filing single, any amount of wages, income above 200,000 is now subject to this 0.9% of tax. Now I know a lot of contractors in the association use third-party companies to do their payroll taxes, whether it's a national company or one of the local companies in your area. Important note on this, as an employer, we are required to withhold this additional Medicare tax if the employee's threshold is if it's going to increase or exceed the threshold of $200,000 for single, $250,000 for married. Where this can get a little messy is if you have, let's just say you have a husband and wife, and the husband works for the contracting firm, and the wife has her own business, maybe she's self-employed or works for somebody else, and the husband makes, say, $150,000 working for the contractor. The onus is still, it's weird because you don't want to cross into the, you got to be careful as far as asking your employees about their personal, personal lives, personal income, etc. But if you have any inkling that they're going to be at the threshold, over that threshold, the employer, the company is required to withhold that 0.9% additional Medicare tax. The best analogy I can give for this is kind of going to the fraud program, which I think I've done for the association in the past. If somebody, somebody makes $50,000 a year working for the company, and they're taking, 4 vacations a year to Europe, Hawaii, and they're buying a new Corvette every year, they're living above their means, which they might have another source of income more than that $50,000. So if there's any inkling by the company from the standpoint that they exceed that threshold, you go ahead and withhold that additional 0.9%. Then if the employee comes to you or shows you proof that they're not going to exceed that threshold, then you don't have to do it. But they kind of throw this extra onus on the contractor, the company, the employer, and I want to make sure that everybody's aware of that, because I know a lot of owners attend the webinars and or listen to them and watch them after the fact. Another situation as we get to the end of the year that is tripping up and kind of catching more and more people is the alternative minimum tax. And that's a tax system that's been around since 1970. And it hasn't been until more recent years where it's caught a lot more of the middle class. And that's because it's never been indexed for inflation until this past year. So you had 44 years or 43 years when the threshold amounts for alternative minimum tax where it would kick in that wasn't adjusted for inflation. And obviously the price of a loaf of bread in 1970 versus today is a lot different because of inflation. The same thing with our wages and the household income that we have. Originally it was set up because the seven wealthiest families in the country were finding a way to file a tax return and pay no taxes because of the way the tax code was written. This is a complex area, so I'm not, as you can see the note there, it's very complex to calculate. I don't want to get too in depth in it, but I want to make you aware of if you have a situation where you're making a lot of charitable contributions this year, a high percentage of your income this year, let's say you have $100,000 in household income this year, and for whatever reason, your charitable deductions this year are at $40,000. When you have an extreme percentage, extreme amount like that, you're likely to get tripped up into hit the alternative minimum tax. And so what they do is in the alternative minimum tax system, deductions that you would normally get for things like charities are pulled back into income. So under the ordinary tax system with that scenario, I would be reporting 60,000 taxable income, not 100. Well, under the alternative minimum tax system, I'm reporting 100,000. So that's how you can get caught in that trap. Your accountant or your tax person should be up to date on that, but it's something you have to take into consideration here as we get to the end of the year, because some of the things we're going to be looking at, some of the recommendations, either pulling more income into this year or pushing it into next year, or increasing your deductions prior to year end, those things will impact the alternative minimum tax. As I said, the good news is they finally are now indexing it for inflation, okay? But the income levels haven't necessarily increased. The exemption amount has been raised, but the income levels haven't increased. And as I said there, the potential pitfall is you could trigger AMT by something like just increased charitable contributions. The exemption amounts, you don't have to be concerned about AMT kicking in if your married filing joint income is $83,400 or less, and for singles or head of household if it's $53,600 or less. Something that had disappeared for a while, but again part of the ACA law a couple years ago, ways to raise revenue, is they brought back what they call the P's limitations. And the P's limitations now impact personal exemptions as well as your itemized deductions. And these P's phase outs now mean, so the wealthier people in the country, incomes over a certain amount, now you're going to get less of a personal exemption. The higher your income goes, the less your exemption goes, where you could end up, if your income level is high enough, you can end up with a $0 amount for your personal exemption. 2015, the personal exemption amount is up to $4,000. So $4,000 for every person that you claim on your tax return in your household. The phase-out amounts for the personal exemption phase-out is $258,250 for single. Married filing jointly is $309,900, and you see the other categories there. It's 2% for each $2,500 of income of AGI that exceeds the threshold. So if you're, as I said, as your AGI gets high enough, you will completely phase out of your personal exemptions. Now, it's not exactly the same for itemized deductions, thankfully. You can never, your income level can never get high enough where you lose 100% of your itemized deductions. The income thresholds are the same as the personal exemption deduction that we just talked about. The deductions are reduced by 3% of your AGI that exceeds that threshold that we just talked about. And your reduction can never go below 20% of your itemized deductions. So you will always, let's say your itemized deductions are $20,000. They will never, in that scenario, your itemized deductions will not go below $4,000. So the reduction is limited to 80% of your deductions. Now, other things, certain itemized deductions don't get impacted by the PHCC phase-outs. Medical expenses is the really large one. That is not impacted by this limitation. You're still limited to 7.5%. Those of us that are younger, and by younger I mean not retired yet, by 2018 or 2018, everybody will, your medical expenses, in order to be deductible on Schedule A, must exceed 10% of your AGI, where currently, and in prior years, it's been 7.5%. So that is still in place. But these limitations here for the higher income individuals do not impact your medical expense deductions. When you get into your investments, talking about pulling, let's say, pulling more income into this year. So you get in a situation, well, should I sell, should I sell some stocks that I have gains on, or I've got some stocks sitting there with a loss? They call it harvesting. So in a capital loss harvesting, you might have a stock out there that's not been doing very well, and you want to use that capital loss to offset some other investment income you have coming in this year. Because it's limited to $3,000 a year, you might want to harvest some of those stock losses that you have. The one caveat on that is that you have to have held this investment for more than 30 days. So if I bought ABC Inc. on November 1st and I bought it at $80 a share, and I sold it on November 24th for $40 a share, it's a huge loss, but I can only, that's a wash sale. It's considered a short-term loss because it's less than 30 days. So capital losses are losses incurred on investments that are longer than 30 days. And of course, they only allow us to take $3,000 of loss per year. But if you're pulling more investment income into this year, that you might want to harvest some of those losses out to reduce your tax liability. Retirement planning, another way that you can reduce your taxes. From the employee standpoint, if your company offers a 401k retirement plan, something like that, max out your contribution. Now, cash flow for your household income, ability to pay your bills day to day, that kind of stuff does come into play here. I don't want you to max out your retirement plan contribution but then not be able to pay your mortgage or your kids' schooling or what have you. But in all cases, when I tell people with, like if you have a 401k and your employer matches, say they match up to 4%, whatever the employer match percentage is, I can't I can't encourage you enough to at least put aside the amount that the employer matches. Because let's use that 4% example. If I set aside 4% and my employer matches 4%, I'm basically getting 8%. I'm getting 100% return on my money. If I don't invest 4%, if I just say screw it, I'm not going to make a contribution to my 401k plan, I'm throwing away up to 4%. So maybe you don't max out the contribution, like it's $18,000 for 2015, so maybe you don't max that out, but if your employer offers a match, I encourage you to at least set aside the amount up to the employer match, because otherwise you're just you're throwing money away. And then, of course, your IRA contributions are deductible if it's a traditional IRA, and for 2015, it's $5,500. For those of us that are over 50, we get a catch-up provision of an additional $1,000 deduction. It might not come directly into tax planning this year, but if you've heard of a Roth IRA, Roth IRAs are also good investments. While they're not currently deductible on your tax return, the earnings, the growth on the Roth IRA dollar amount grows tax-free. So to give you a quick comparison of the two, the traditional IRA, $5,000, we set aside $5,000, we max out our IRA contribution. Let's say we're younger than 50 years old. We're able to deduct that $5,000 off the front of our tax return under adjustments to income. And then so we pay, it lowers our taxes. But then 20, 30 years down the road, when we pull that $5,000 out of our retirement account, we pay tax on that $5,000, plus we pay tax on any earnings on that $5,000 that we may pull out as well. With the Roth IRA, that same $5,000 is not deductible on the front of the tax return, so it's not an adjustment to your gross income. So it's not reducing our gross or taxable income, but we're putting that into a Roth IRA retirement account. 20, 30 years down the road, that $5,000 stays in there and grows and grows. When we pull that out 20, 30 years down the road, since we didn't deduct it 20, 30 years ago, meaning we contributed after tax money of $5,000, we don't pay tax on it 20, 30 years down the road when we pull it out. And the other nice part of the Roth IRA is it's not tax deductible now. Any earnings that you get over those 20, 30 years that you pull out of a Roth, also you pull out tax-free. So that's a difference between the IRA and the Roth IRA, but either, I believe, are great investments. Talking about tax rates and where you fall as we get to the end of the year, you can also consider if you are in a lower or you expect to be in a higher tax bracket, say next year, and you have IRA you have an IRA account, assuming that you are 59 and a half or older, and that's the threshold. If you're younger than 59 and a half and you pull money out of your retirement account and it's not for medical or education expenses, you get nailed with a 10% excise tax penalty. So that's why I say if you're older than 59 and a half to pull it out, you can do that. What you can do if you're younger is you can convert a traditional IRA to a Roth IRA, even if you're younger. And so what you would do is you basically would pay the tax on it now, even though you roll it over into a Roth. And any earnings from today forward, once you've converted it to a Roth, then all those amounts are tax-free. but you have to pay the tax right now on what your balance in your traditional IRA account is if you convert it from the traditional to a Roth. But if you believe your tax rate is going to be higher, going to be on a higher tax bracket next year, that might be something that you want to consider doing right now at the lower tax rate. A couple of points about the state and gift taxes on the individual side. Right now the tax rate is up to, it's not as high as 55.5 like it used to be, but it is 40%. The exclusion for each person is $5,430,000 of assets. That's for each. So if you're married, a husband and wife each have that exclusion. Combined, married couples exclusion would be almost $11 million. And that's, there's some other aspects that get involved into estate planning, which is not the purpose of this topic, but I do want to at least remind people what the rate is, and when you're doing year-end tax planning, looking at estate tax planning with your CPA is not a bad idea as well. If you have children, nieces, nephews, grandchildren, and you want to give them a gift, you have a gift tax annual exclusion for 2015 is $14,000. That is per individual. So again, husband and wife can give up to $28,000 to an individual, which, believe it or not, does not actually even have to be a family member. It could be, somebody that works in their yard or somebody they know. They can give each up to $14,000 a year and avoid the gift tax. One little planning opportunity here when it comes to gift, if you have somebody that's got a lot more wealth and they're going to be gifting, say, $14,000 to their grandkid for college or whatever, there's no law that says the grandparents can't pay for the tuition, let's say college tuition, directly themselves. So if you want to find a way to gift even more or get more money, like down to the grandkids as an example, the way to do that would be to pay their tuition directly. So you, the husband or the wife or both, write the check to the university or the school, if it's a private school, and then you can still give the grandchild $14,000 each. Again, I know that is only for people in the higher tax brackets, but that is one planning opportunity that I learned about this fall. This slide might look familiar to some of you that have attended the year-end tax planning program in the past, and this is the traditional tax strategy, and that's where we are at this very moment right now, because a lot of stuff, as I'll discuss in a minute, is in limbo. So it really is, at this point, is if right now, if you believe next year you're going to be in a higher tax bracket, then your planning opportunities would be to pull as much income into this year. So if you're a partnership or S Corp and you're going to pay yourself a year-end bonus, you pay it or you record it on the books before the end of the year, so you claim it on your 2015 taxes. And with that strategy, we're trying to pull more income into this year. If you're going to be in the higher tax bracket next year, you push the deductions into 2016 when they'll have more value. They'll have more value because you're going to be at a higher tax rate. So the deduction next year is going to be worth a higher percentage, so to speak. Now, let's say next year you're going to be in a lower tax bracket, the opposite. You're going to push all income. So that year-end bonus you were going to write yourself, instead of writing it December 30th, you write it January 2nd and call it a 2015 bonus. But it then shows up on 2016 taxes when you're in a lower tax bracket. And same thing, since we're going to be in a lower tax bracket next year, that means we're in a higher bracket this year, we pull deductions into this year. So if we can pay our state and local income tax fourth quarter estimates, if we can pay them by December 31st, rather than early to mid-January, we can claim, we can deduct them on Schedule A this year. You're going to make a contribution to the PHCC Educational Foundation, which I obviously support and strongly encourage you to do as well. You can do it this year and next year. But the point is, if you're going to be in the lower bracket next year, that you want to pull the deductions, anything you might deduct into this year. So charitable contributions, interest expense, medical expenses maybe, by bunching them together, like pulling them into this year, it will give you a higher deduction amount. And since you're in the higher tax bracket this year, that will reduce the amount of taxes that you pay. And by pushing that bonus or whatever other income, you might, if you're a cash basis taxpayer, instead of doing invoicing on December 30th, if you're going to be in the lower bracket next year, you wait to do your billing till January 2nd or 3rd. Okie doke. So, I said some things are in limbo, and I thought this slide in this picture was appropriate for the time of the year we're in. And frankly, a lot of people right now do consider Congress the Grinch. Here's some tax benefits that are in limbo right now. These are things that we're waiting on, and actually as we speak there is, and I'm sure Wayne and John and those at the national office could speak a little bit more on this because they're more in the know right down there in DC. But there is part of these tax extenders, some of these deductions and tax benefits that we've had in the last few years are, there's a bill that's been introduced to extend those extenders, if you follow along with what that means. But it's not, it hasn't been signed into law yet. It's debated. It's being debated in, I believe, the Senate. The problem is they've worked this into part of the overall budget bill, and it's bogged things down. We've got some back and forth between either side of the aisle on certain aspects of these tax extenders for businesses and individuals. But the individuals ones right now that are limbo, the last few years you've been able to deduct, if your state, and I know some of the states like Texas doesn't have an income tax, or Florida and Nevada, I think, are three that come to mind right off the top of my head. Well, you don't pay state income tax. You have no deduction on Schedule A for state income tax. But under the sales tax, you could deduct what you paid in sales tax in Florida, Nevada, or Texas, those states that don't have state income tax. Right now, that's gone. That provision is gone. Deducting private mortgage insurance, gone. Teachers' expenses, $250 out of their personal pocket, that is gone. Qualified tuition, that's in limbo right now. Discharge of principal residence debt, short sales. Those of you that, and hopefully nobody here did, but if you know somebody that got caught in the real estate collapse and sold their house for less than it was worth, those provisions, all provisions are in limbo right now, waiting for Congress to pass the law. So my word of encouragement here is, I know the Government Affairs Office for the PHCC National does a great job, and I know they'll be on top of this, so watch your weekly PHCC newsletter that comes out. If and when I hear anything on my end, I'll make sure that Wayne and John are aware of it and share that as well. This could be something that comes, right down to the end of the year like it has in prior years. When we get to the corporate, get towards the end of the corporate stuff we're going to talk about, I'll mention my, what I think is going to happen there, or what I think is not going to happen there. So some last-minute planning tips. Again, these are on the personal side. Prepay any deductible expenses you have. So before, if you're going to be in a lower tax bracket next year, then tuition payment you might have that's due January, make that before the end of the year. State and local tax estimates, as I mentioned, harvesting some capital losses, gifting appreciated stock. If you have some shares of ABC Corp that have gone, that were worth $40 and now are worth $80, you can gift them to a charity like the PHCC Educational Foundation, and you get the increased deduction. The foundation gets the proceeds, or gets the stock, which is value, but you get your deduction on the tax return at that $80 a share, not the $40. And if you think about it, if cash flow is an issue for you, that's still a great way to help a charity out and not have to actually write a check or have actual dollars come directly out of your pocket. So that's another great thing that I know some individuals have done. By the way, if you do are so inclined to make a contribution to the foundation, you can find more information at phccfoundation.org/invest, or you can contact Wayne, John, or myself. Any of us would be glad to help you out with that, since we're talking about charitable deductions and increase, selling off or gifting stock, to a charity. There's a few things going on the business side. Let's take a look at those. I know we don't have a lot of time left. As I finish the individual ones, here we are at the beginning with the corporate ones, and same boat. Different picture here, but the same situation. We're waiting on a decision. Things like the increased Section 179 expensing deduction, bonus depreciation, research and development credit. A big one for us in our industry, that old 25C energy efficiency tax credit. They are trying to bring that back, but right now it is in limbo. So, we do, as an industry, we do have some serious skin in the game to a degree when it comes to these, some of these things we're waiting on, and then a couple other ones as well. Here's the thing, Section 179 expense, whoops. In 2014, it was $500,000. In 2015, it's $25,000. Huge drop. So, if I went out and bought a Sprinter last year to put, say I put a new service truck on the road and it was $60,000. Last year, I could write that whole 60 off, 179 it. This year, I can't. I'm limited to $25,000. I think eventually something's going to get done here. They're trying to make that $500,000 limit permanent, but I have to be honest with you. Right at this moment, I'm not real confident about this specific item being increased in 2015. It's just, I hope I'm wrong. It's just a gut feeling from what I'm hearing out there. What I'm hearing hasn't been good. For the company, the same thing on the individual side when it comes to retirement plans. So if you're a small employer and you don't have a retirement plan, you could start one, set one up. You can maximize the contributions for your employees to your retirement plan, whatever type it may be, whether it's a IRA SEP, profit sharing plan, 401k, what have you. Maximize those contributions. That reduces your tax from the company corporate side. Small business health care credit, that is available. That's part of, obviously, the ACA health care law that was passed a couple years ago. So if you're a company that's got no more than 25 full-time equivalent employees, and their average annual wage is no more than $50,800, you may be eligible for a credit. That would be up to 50% of what you actually paid for their insurance, or what you would have paid had they been enrolled in one of the, oh crud, I'm forgetting the word, shops, like the, marketplaces for health care. And the one nice thing about this, at least, is, well, one point, first of all, you have to at least pay 50% of the employees' premiums in order to be eligible for this credit. The nice thing is if you end up showing a loss, you can, on your corporate return, you can carry forward that credit. Here's something I want you to be aware of that I'm not going to get into, but it was more since I had the chance to bring this to everybody's attention, I want to do this. Last year, capitalization and repair regulations were finalized. It does impact your corporate taxes from the standpoint of the depreciation area. It's a huge mess. It's very complex, but the reason I want to bring it up, it's really easy for you to do something what seems innocuous and all of a sudden blow your, by not properly reporting something, you could all of a sudden mess up with your method of accounting and cause a problem with the IRS and taxes and penalties. It all relates to expenditures for repairs, maintenance, things like that. The only note I want to make on this is it was a huge thing, and thanks to, among other associations, the AICPA, which is essentially the PHCC for accountants, we got the safe harbor dollar amount to be raised from $500 to $2,500. Essentially, the way the new laws are written, if you spent $750, let's say, to repair a part of a truck, you might have to capitalize that $750 rather than expense it. Obviously, the benefit to the IRS is, well, you have to pay higher taxes. You're only able to take that deduction. You have to depreciate it over a longer period of time. But one of the aspects of this whole mess is you have to have a sample company policy in place regarding repairs and maintenance purchases. So these next two slides you're going to see are a sample policy that the smaller contractors out there that you can use. I recommend you talk to your accountant if they haven't approached you about it yet. Feel free to print these out and show it to them. Say, hey, do I have something like this in place so we're covered when it comes to this? If you don't, you can use this. Obviously, change the names, to reflect your own company. But this is essentially the language that you would need for that policy. So those two slides right there, you could print out, and basically that's a sample policy for you. Something else that's come up lately, and hopefully nobody here has been had a problem, kind of been caught up in it. I know a few of my clients have the last couple of years, unfortunately, and that's identity theft. And identity theft has become a very huge issue for the IRS. So much so that they have basically been spending the last 12 to 18 months overhauling their security system. Essentially what happens is, let's say I'm going to go file my taxes for the year, and somehow my identity, social security number, name and stuff is stolen, and I'm going to pick on Wayne. Not that he would ever do this, but Wayne gets my social security number and basic information. He files a tax return, false, makes numbers up, but gets $5,000 to $10,000 refund. IRS sends him a $5,000 to $10,000 refund. 3 weeks later, I go to file my tax return, and the IRS goes, tax return's already been filed for this social security number or for this employer ID number. And now you, as the victim, are in it's a huge mess. You've got a huge headache on your hands, and it's been averaging 4 to 6 months to get it straightened out with the IRS. They have some procedures now in place how to do this, but like I said, hopefully none of you have been a victim of that. I've seen it a lot more in the last couple of years, so much so that it's really worth mentioning to everybody. One of the other things that we're waiting on right now, I don't know if I mentioned it, as far as the extenders being extended, was the bonus depreciation. I'm not going to scroll back to that slide, but we talked about the Section 179 deduction being currently only $25,000 for this year. Also in previous years, we had the 50 or 100% bonus depreciation amounts that we were able to take. And while that is part of the bill as well, right now, that's not in play either. So especially from the uh, depreciation aspect. Businesses are really getting hammered between the repair and capitalization regulations and the drop, the removal of the bonus depreciation and the reduction in the 179. We're really getting hit in that area. Wayne, I would say if after the, if you're reviewing the slides later or you think of a question later, John and Wayne will have my email address. Feel free to email me at any time, and I'll be glad to answer them as best as I can. So if you find something that down the road, a question, go ahead and send it to me. I'll be glad to do that.